Hello, everyone. Today on The Final Bar, I'm joined here in the studio by TG Watkins of Simpler Trading. We'll talk about this market environment as we now lick our wounds after the Fed meeting yesterday. What next? We've got some earnings to talk about. Apple and others continue to give us a news flow to digest. At the end of the day, where are the trends? Ladies and gentlemen, this is The Final Bar. Hello, everyone. Welcome to The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform was designed and started over 20 years ago as a way to empower individual investors to better understand the market around them. These days, our platform is used by individual investors, financial advisors, institutional investors, many more, to try to make sense of these markets, particularly in periods of volatility. Now, the market feels uncertain. The market feels volatile. A lot of our measures of volatility not necessarily as elevated as you might think, although this week we're certainly seeing a spike higher in the VIX, some other measures of volatility as well. What are the breadth conditions? We're going to dig a little bit into the breadth and see how we can define the narrow leadership trend that we've seen so far. Where are the opportunities? Where are the trends still strong? It's in a relatively small number of stocks. We'll highlight some of those. Also, highlight some of the names struggling and thriving in an earnings season that's giving us more and more headlines to digest. Let's get right into our market recap and look at some of the charts that are top of mind as we reflect on what's happening through the course of the trading day today. Sort of a noisy day, right? Yesterday we had that waterfall decline, the Fed meeting, a lot of volatility. Today was a little more muted. We sort of opened lower and then traded quite around sort of current levels. The S&P finished the day right around 4060. That's down about 0.75% from yesterday's close. The NASDAQ composite just below 12,000, down about 0.5% from yesterday. Mid caps and small caps pushing even further down, with the mid cap index, the S&P 400, down 1.7%. The only indicator, the only chart on the green here in this top list of market indexes and measures that we track is the VIX. And you note the number on the VIX, it's above 20. Now, that's important, I would argue, because we've talked so many times about the VIX being relatively low, and the fact that VIX is remaining below 20 says that even though we're spiking a little bit, it's not that bad. Well, as of today, we're closing the day with the VIX back above 20. That is my back of the envelope, very basic definition of are we in a volatile environment or not. Getting back above 20, I would argue, tells us we're more in the volatile category. Now, compared to the last 12 months, still relatively low. However, we're starting to see some signs of elevated volatility. Certainly the uncertainty that yesterday's Fed meeting and all the earnings, I think, are compelling us to think certainly very much alive and well. We'll look at a chart of the VIX here in a little while, but let's check in on some of the other markets first. Interest rates overall moving a little bit lower today. The 10-year yield's down around 335. Long bond yield actually pushed a little bit higher to 372. The short end of the curve, of course, still pretty high. This is more closely related to the Fed's activity, raising rates again this week. The longer end of the curve, more defined by market forces. And you can see that interest rates on the long end still relatively low. And again, that 10-year point is the one we track most often, down about to 335. Dollar index up a bit, but not too much. The UUP, which is a bullish dollar ETF, only up about 0.1% today. A lot of green on the chart of commodities with a couple exceptions. Gold and silver are two areas of the market where we talk about pretty often. You can see that those are both in the green. We recorded charting forward our second quarter market outlook panel earlier today, just a short while ago before going live with the Final Bar today. We talked a lot about gold and precious metals and what that means. Gold, of course, testing all-time highs around 2,000 an ounce. You can see that the GLD currently just above 190. That's up 0.7%. Silver prices 2.2% higher. That's using the SLV, which is a silver ETF. Crypto land overall mostly in the red, particularly the most common ones that people tend to think of. Bitcoin down about 0.6%, Ether down about 1.6%. It's interesting how closely in some periods that risk assets and you'd sort of group cryptocurrencies in with other risk assets, right? Stocks up, cryptocurrencies up, stocks down, cryptocurrencies down. We're seeing that a bit today, of course, with stocks and cryptocurrencies both sort of on the downside. But look at the relative performance, and I tell you, it's been pretty clear. If you had a choice of owning Bitcoin or the S&P 500, one of those clearly outpacing the other, and it's certainly not the S&P. Let's look at a chart of the S&P 500 and just get a sense of where things are at, what today's move does to the longer-term charts that we've been talking about. Here's our daily chart of the S&P that we often bring up. A couple things that come to mind as we're looking at this chart. Number one, look at how the 4,200 level, and really probably loosely group it as maybe 4,150 to 4,200. This is where we've tested a number of times here. Going back to the February peak, we sort of pushed back up there in mid-April. Now in late April, we once again attempt to get above 4,200. That's where we've stalled out every one of these times. That big, thick green dashed line or dotted line on here really identifies that important level of resistance. And when you've had a run like we have off of the October lows, my question is always, do we trade not just to resistance, but through resistance? What's happened over the course of the last week or so is we had this bearish candle pattern. It's actually called a shooting star candle or a gravestone doji, if you want to get technical. However, what it basically means is short-term distribution, right? We opened, we traded up to 4,100, almost to the penny, but by the end of the day, and this was on, I think that was Friday of last week, we actually traded more toward the lows of the day. Sorry, that was actually Monday's session. Then we have Tuesday, Wednesday, Thursday. We're actually back down the 50-day moving average, which is here in blue, once again in play. Now, the 50-day moving average on its own, not necessarily the best trading system in the history of the S&P 500, but generally, as a basic guideline, is a particular chart above or below a 50-day moving average is a basic assessment of short-term strength. Is it above or below the 200-day moving average? I think is a basic assessment of long-term strength, right? And again, while it's not a trading system I would put a lot of money behind, as a general measure of trend strength or weakness, I found it to be very, very helpful. So the S&P remaining above an ascending 50-day moving average, how bad are things getting? The S&P starts breaking below the 50-day. The 50-day starts sloping downwards. Again, those are the sorts of things, the sort of red flags that would make me revisit a bullish thesis in this market. Also notice the momentum characteristics, right? Start the clock in February, which is when the last time we just barely touched the overbought region. From there, this market has been neither oversold or overbought. When it's gone lower, the RSI's remained above 30. When we've gone higher, the RSI's remained below 60. So we're really in this neutral range right around 50, sort of going above and below. So when we talk about this choppy, sloppy environment, sort of this no man's land, the wilderness, until some sort of significant move happens, the RSI here on this chart is one of the things that just comes to mind, sort of recognizing that neutral momentum characteristics. Now, we're going to talk a little bit about breadth today, certainly with my guest today, T.G. Watkins. I did want to highlight one of the charts that comes to mind for me. I'm going to go to the Mindful Investor Live chart list. This is a list of charts that I keep updated on the StockCharts platform. And this is one of my favorite charts to think about breadth, and it looks at breadth by cap tiers. We're going to focus in on this bottom part of the chart just to show you three different measures: large cap, mid cap, and small cap. This is going back over the last year. This is the advanced decline line, the cumulative advanced decline line for the S&P 500, for the S&P mid cap, and the S&P small cap. Do these three lines look very similar to you? I would argue very much no, right? One of these is well above its 50-day moving average and testing its February swing high. One of these is nowhere near its February high and is right at its 50-day moving average. The third one is nowhere near its February high and well below the 50-day moving average. That is what it means to look at large caps versus mid caps versus small caps. And this is not a cap-weighted index. These are equal-weighted indexes, literally counting the number of stocks in each of these buckets that are in a position of strength, meaning are they above their 50-day, above their advanced decline lines going higher or lower, right? Over time, are stocks moving up or moving down on any given day, and how do we aggregate those values over time? So the fact that large cap sort of in the testing resistance mode, whereas small caps are nowhere near that, that is the reality of investing in May of 2023. And if you've not gotten your head around that, I would encourage you to think about what that means to go lower in the cap tiers, what it means about the cap-weighted characteristics and the strength in the biggest names that comprise our industry benchmarks. Let's look at a couple individual charts and sort of take a step back and think about what these charts are telling us. We're looking at the regional banks ETF gapping lower again today. This is the KRE. We highlighted this, I think, on yesterday's show or the day before. There's no doubt that regional banks are struggling. When we talk about sort of this banking crisis, this financial crisis, the regional banking ETF, KRE, is probably one of the ways to magnify the movement here and magnify and reflect on the impact that we're having here. Again, it's interesting to me that some of the larger names, a chart like Microsoft, is really not reflecting the weakness that we're seeing in the banking system. The KRE is really showing that we're in a panic mode as we're in sort of a waterfall decline. And it's, of course, comprised by charts like Zion, Z-I-O-N, which is down another 12% today. So when we talk about the banking crisis is behind us, which is a sentence I actually heard someone say not too long ago, I'm scratching my head looking at a chart of Zion's, looking at the KRE, looking at some others, even the XLF, which, of course, also has some of the larger banks. This is not a chart in a bullish phase. This is a stock and a series of stocks and ETFs and industries, I think, that are below the measures of trend. They're below, telling you that we're in a position of weakness, not a position of strength. Get optimistic when these charts stop going down, not when they're in the middle of going lower. The weakness, of course, is not isolated to the financial sector. Peloton down about 13.5%. This is an earnings name this week. Again, the gap lower may be a surprise depending on where you came out on what this company is doing. What's striking to me, though, is what this chart looked like in early February. This is as the S&P is pushing higher, testing 4,200. Peloton's actually making a new swing high. And I remember looking at this chart and thinking, wow, this is a big inverted head and shoulders bottom. We've broken above the neckline. This thing could go materially higher than what we've seen so far. We now, though, have seen that this is a failed breakout. This is not a bullish development. When you see bullish charts with strong triggers that should go much higher and then don't, that is the sign of a market in a bit of a concerning setup. Paramount is another one, of course, down quite a bit today, almost 30% today, gapping lower, now retesting the lows from the fourth quarter of last year. But again, I think this is the latest in a series of moves that have shown you that we've been unable to get above resistance. We're no longer in an uptrend. Now we're sort of backing and filling at the lower end of the range. The last one I'll show you, then we have to take a quick break. AT&T. Now, when you talk about head and shoulders tops, I'm detecting a bit of one of those right about here. You take the head, which is the peak in late January, early February, take the lower peak in December, the lower peak in April. We've now broken the neckline. That measures further than what we've seen so far. So you're seeing weakness in this mega cap name and communication services, but potential further weakness to come. Folks, let's take a quick commercial break. We'll be back with my guest, T.G. Watkins of Simpler Trading. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. We have a great guest today, T.G. Watkins of Simpler Trading. Before I bring him on, I just want to let you know about a couple things. First off, we welcome your feedback on the show, our new studio, what we could do better, but particularly we welcome your questions. Our mailbag segment, which we will do on Friday's show, is fueled from viewers like you sending in, emailing us your questions. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV, and we're on YouTube. Just put a comment below the video you're watching on our Stock Charts YouTube channel. We'd love to hear from you. Hope to answer your question live on the air on Friday's show. Upcoming schedule, we had a great time recording Charting Forward, our mid-year sort of second quarter market outlook. That'll be airing this Monday, the 8th at 11 a.m. Eastern. That features today's guest, T.G. Watkins, also Miss Schneider of Market Gauge and Julius DeKempener of RRG Research. On Tuesday of next week, on May 9th, we have Jay Woods of Freedom Capital Markets joining us from New York. And then I guess it's New York week next week. Wednesday the 10th, we have Frank Capilleri, who now has his own firm called Cap Thesis. We'll see what charts are top of mind for those guys next week. I want to welcome on today's guest, T.G. Watkins. T.G.'s the Director of Equities at Simpler Trading, right here local in Seattle, Washington, and we are super fortunate to have you live in our studio. T.G., welcome.
Yeah. Thanks, Dave. Appreciate it. You know, not too long of a drive from where I live to come down here. You guys have a wonderful place. This is pretty impressive.
Easy commute down. I hope this is not the last time we have some good conversations in the studio, T.G. It's been a pleasure to get to know you and your work here over the last couple of years. I'd love to dig into some of the charts that you were seeing. We've talked about a lot of different themes, about the major averages sort of stalling out potentially, the gap between large and small. We have your charts looking at the SPY and the IWM. Let's start there and talk to us about what you're seeing.
Yeah, certainly. We have a lot going on. But if you can look at the charts here, we can see that I've drawn a yellow line on the SPY. And what we're showing is that the S&P is basically up at all-time highs on this last one. It's up at an area of resistance at its highs. But then we compare that to the IWM, the small caps, and this looks like it's at its lows and just about to break lower. And so there is a big discrepancy. You were kind of talking about it earlier. And what I'm kind of looking at is how long can this discrepancy, this divergence actually maintain? Because at some point, something's got to give. I mean, Is the IWM suddenly going to turn up and we're going to get the S&P to then break out? Or is the IWM kind of showing us that no, actually some things are pretty weak out there and we're going to pull the rest of the indexes down? Because we were talking earlier that breadth is not very good and that a lot of the strength has been very narrow. But one thing to really call out in this chart for the IWM where the big arrow is, two things. One, that we've seen price has been what we can now see bear flagging into that downtrending daily 50 SMA. And then if you look at the Moxie indicator just below there, it has been staying underneath zero. This is a confirmation based on my rules and then what I teach that this is a confirmation that this is most likely going to be going to the downside.
When and it's been fantastic learning about the Moxie indicator, how you use it, and in your show on StockCharts, you do a great job of sort of applying it. For those that haven't watched the show before or aren't as familiar, when I think the Moxie indicator, I think momentum is my initial reaction. How would you describe, for those that aren't familiar, what is this telling you, seeing the Moxie indicator below zero on the
That's exactly it. It is a momentum-based indicator, and so what we're trying to do is demonstrate momentum. We're trying to show if the indicator is above or below zero, you have positive or negative energy, and the stair steps are kind of telling you how much energy. The last couple times that you've seen the indicator go green, cross over zero, those stair steps have been large. That means there's a lot of momentum, a lot of energy going in each one. But it's a stark difference to what we're seeing now. There's very little green. In that green, those stair steps are all very flat. There is no energy in here. And so I'm starting to see that there really looks to be something different. The IWM has been going sideways for an entire year, but the last 3 times that it's come in contact with the daily 50, it's been able to cross it. This time it doesn't look like it's going to. This really looks like something different.
I feel like there's a big difference between the S&P going higher with small caps not participating versus small caps going down, right? That's sort of a different feel. And we're seeing some earnings this week, which is starting to back that up, right? We're seeing some weakness, and the charts are certainly reflecting that. Can we talk about volatility? We talked about the VIX earlier today, you and I, with others in the studio here. You know, when you're thinking about the volatility environment, we just talked in the market recap about the VIX getting back above 20. Talk to us about your perspective on volatility, what it means here.
Well, the old adage, VIX low, look out below. So, we've got that. I also do look at the put-call ratio. And in fact, the put-call ratio, the way it ebbs and flows has been working out very well for us. And so I was able to call the top in the market because the put-call ratio is very low. And now we're watching it creep back up. So if people are saying, okay, when are we going to turn, how far this is going to go down? It's like, keep an eye on the 10-day moving average of the put-call ratio and see when it gets high. And that might mark a bottom. But as far as the VIX, I like to look at the UVXY. It is the it's the leverage ETF. There's the UVXY and there's the UVIX. You can kind of choose which one you want to use. But they're the ETF version, the leverage ETF version of the VIX.
Got it.
I like it because it gives me a better sense than the VIX itself to actually tell when traders are coming in here. I can see volume. I can see patterns that are starting to set up. My Moxie indicator works well with it. And you can see that on the hourly chart, over the last several weeks, we've seen price come down and the Moxie indicator has been coming up towards zero. That's some positive divergence. And you'll notice right when the Moxie indicator crossed over zero is right when we got our first little blip, our first little move. So timing-wise, the Moxie indicator was doing great and actually leading us into this. And so we took a couple trades around there. And then, the market kind of bounced up and then pulled back, and now we had the FOMC. And you could see the Moxie indicator right on time got another green arrow right into the FOMC when the market started to roll over. So all of these things, we've been trading it, we've been doing well with it, and you can see it basically is a bottoming pattern here. And so the only other thing I'll be calling our attention to, and I've been a little bit cautious about this, but I do want to make note of it in case it turns into something. On the daily chart, we've had price stay under the 50 SMA, but the Moxie indicator has been above zero. This is what I call a trampoline move. And so if you can think about it, if you jump on a trampoline, it shoots you back up. So if this is going to work, and if it actually follows through, and this shoots the UVXY up, that is a big move to the upside and a big move down for the market. So I'm keeping an eye on that one.
So I was going to, and just to be clear, daily chart on the left, hourly chart on the right. A brilliant illustration of how to think about different time frames with your indicator. Arguably, with most indicators, that's probably a good way to think of it. What does that mean if we see this rotation higher in volatility? What does that mean for the broader market environment?
It means things are getting weak. I mean, a lot of big traders use the UVXY, the UVIX as a hedge. And you can start seeing when traders start to go into this and don't believe what the market's going to be doing. In fact, when you see the UVXY go up with the market going up, usually the UVXY is calling the bluff of the market.
And
so those are some key things that I look for.
That relationship usually does not hold.
No, they should be opposite each other.
That's exactly right. And the market usually catches up to what the volatility is telling us.
So the fact that this is basing and starting to wake up, means that we need to be aware of what's going on with the market.
That's a great point there. Your last chart is really looking at breadth, and we talked in our market recap of different measures of breadth. We looked at the cumulative advanced decline lines, which really, again, it sort of backs up your point. Small caps just so much different and so much less constructive than what we're seeing with the mega cap stocks. Talk to us about your chart looking at breadth indicators and what it means about participation here.
Yeah, it's not just the big caps versus small caps too. We are seeing this inside of the NASDAQ, inside the S&P. There are fewer stocks participating on this move up. And what we've been seeing, we have the 200-day and the 50-day, number of stocks over their 200, number of stocks over their 50-day.
Yep.
They are not nearly as high as the S&P is. The S&P has managed to come up to its previous high.
Right.
The rest of the market has not. And so this is what it's telling us, that yes, there might be stocks that are keeping the S&P up, like Apple or Amazon, the small, big cap, but small, narrow breadth going up there. The rest of the market is not following along. And at some point, this divergence is going to kick in and usually take the market down. I think that's kind of what we're seeing here.
So I'm getting some cause for concern, I guess, or just a little observation. Certainly some internal weakness. We're seeing that in small versus large. We're seeing that with breadth conditions. When you're looking at this sort of market, how do you play that sort of environment? Are there general ways that you would protect to the downside or get defensive? What does that mean in your process?
Yeah, a lot of times, especially in this market, trying to hold through pullbacks is just not really happening. We can see things go up with the market, but then as soon as they peter out, they really roll over. So there's no, for me at least, there's really no holding through these waves. It's like just ride the wave and get out or go short. And we've been seeing that around. For me, I play contra ETFs like SPXS or the SQQQ.
Yep.
TZA, I like to play the UVIX. I mean, I do all these things to help mitigate some of the risks that we get with individual stocks. When we get into markets like this where you don't know what news is going to come out there and big moves and maybe have earnings, or maybe Roblox came out and said, well, we're not going to tell certain numbers during our earnings. They drop even before earnings. And so if you're going to be playing in this kind of market and you're trying to reduce some of your risk, like you're just random risk, play the ETFs. They'll be a little bit easier and smoother to work with.
Interesting. So when you're looking at something like the S&P 500, talk me through what the alternate hypothesis might look like. I guess to ask another way, I guess there's a scenario where conditions just start to improve, right? What if volatility rolls over and goes lower? I agree with you. I don't think that's the likely outcome, but it's possible. What would you see on the chart of the S&P from volatility that would tell you, okay, hold on a second, this actually isn't as bad as it seemed. Things are getting better. Is there a certain level or a signal that would convince you, okay, this is now lights out, we need to be back long or on the long side? It's
going to be a couple things. I saw earlier you were talking about, hey, at least price is over the 50 and at least the 50 is over the 200. So if we can maintain that somehow, then okay, we can keep going up. But I'm concerned about how long this can happen or maintain itself if there's just not a lot of participation. So I'm going to be watching the breadth indicators. If those can cycle back up and more stocks are starting to behave well and actually participate, then okay, I can start looking at that again. Other indications is, we want to see the UVIX or the UVXY start to roll over and go down again. We want to see the VIX go down. But we're at an area to where all of these things, the put-call ratio, the VIX, they're all lined up to where we at least need to have a recycle, a refresh. The market goes in waves, and right now it's all pretty much set up that we're kind of at a high, and we need to come back down. Now the question is, it's easy to figure out that we need to come back down. The question is, are we going to keep going down, and does this get worse, or is this just going to be another cycle low, and then we cycle back up? We're going to have to wait and see how that goes. But it's the wave, basically.
When in doubt, let's watch the evidence the market provides back to us, right? TG, this was awesome. Some really good charts. Really appreciate you featuring your own indicator, the Moxie indicator. I know that's a plugin that we have on the StockCharts ACP platform, which is very well received. Awesome to have you in the studio. Maybe next time we can do it in midair around Seattle.
Yeah, let's go for a flight.
As we're flying around. But thanks for coming in the studio today. Good to see you. Folks, we need to wrap the show. Go to the 3 and 3. 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. We talked about a number of different things today. Talked about breadth conditions, talked about narrow leadership. At the end of the day, I love thinking about different ways to identify trend, to anticipate trends, and really to clarify which way we see the trends going. I'm looking at the S&P on a daily chart here, and I'm just using the simple PPO indicator. This stands for percent price oscillator. It is based very similar to the MACD indicator, which is widely followed based on moving averages. It uses exponential moving averages. The PPO, I think, is just an improvement on that, using percentages instead of using absolute price returns. In the end, the interpretation is just the same. I put some vertical lines just to show you when we've had these traditional buy and sell signals. When the PPO line crosses up through the red signal line, that's a very simple buy signal. When it's above zero and crosses back below, that's a simple sell signal. Again, is it the most perfect trading system in the world? Maybe, maybe not. But I tell you what it does do is it really helps just clarify what is that short-term trend in the market. Usually these trends, as you can see, have lasted about 2 to 4 weeks, maybe a little bit longer depending on what's happening. The most recent buy signal we got was in sort of mid-March, coming off the low there. You saw the buy signal as we went below zero, turn back higher. Next couple weeks, 3, 4, 5 weeks, we're going to the upside. This is as the S&P is getting just above 4,100. But look at what has happened as we get into the month of May. Again, the seasonally weakest half of the year is what we're starting. That sell in May phenomenon is named after the fact that May actually tends to be a little weaker rather than stronger. We may be seeing the beginning of that, and I noticed as I was reviewing this chart earlier, we did get a sell signal from the PPO indicator at the end of April. So certainly one of the many data points telling me to start thinking about potential downside risk and what that might mean for a portfolio. Chart number 2, I was asked from one of my market misbehavior premium members earlier today about equal weighted sector ETFs. The comment was made, the XLK is really 2 stocks, right? And then a bunch of other things. And you're absolutely right. The XLK is heavily weighted to Apple and Microsoft. If you look at the XLY, it's heavily weighted to Amazon and Home Depot and Tesla. Communication services, it's Alphabet and Meta. A lot of ETFs have that issue where it's highly concentrated in the mega cap names, particularly the growth sectors have that issue. This chart is looking at 3 data series. From the top, we have the relative performance of the equal weight technology versus the cap weighted technology. And then I'm looking at the RYT, which is the equal weight technology, the XLK, which is the cap weighted technology. The ratio going lower shows you how the equal weighted version has been underperforming the cap weighted version. That again reinforces this idea, this reality that the biggest names have been really driving the lion's share of the movement in the ETFs. At the bottom, you can see how the XLK is once again testing a new swing high, but the equal weighted version of the technology ETF is nowhere near the February high. That's that differentiation. That's the reality of the average technology stock versus the biggest technology stock. Now, the indexes will show you, the S&P, the NASDAQ 100 can show that as long as those mega cap names are doing well, things can hold up okay. But look out below if charts like Apple and Microsoft start to break down. That's why I think those are important charts, as always, but certainly important to watch right about now. Finally, a random stock you may or may not be familiar with. This is just above sort of that mid-cap range for me. It's just below $12 billion in market cap. It's a company called Teleflex. TFX, this is a medical supply stock in the healthcare sector. One of the marks of a bear market phase, in my experience, is failed breakouts. In a bull market phase, stocks break out and then they keep going, right? You have a nice level of resistance like we do here, what I might call a basing pattern. First reached this level around 250, we'll call it 260 in December of last year, retested it in January, retested it in February. We then broke above it in early April and then pushed higher. And just a couple days ago, this looks like a very strong chart above 2 upward sloping moving averages. One earnings release, and all of a sudden it's gapping to the downside. The bearish divergence is one of the things I'm noticing on this chart. Stocks that try to break out and fail to hold it are not the sign of a bull market phase. Charts like this, the more I see these, tell me to be concerned about potential downside risk. As always, keep a wary eye on your stops. Folks, that's a wrap for the show. I want to thank you so much for joining us every weekday after the close for the final bar. Special thank you to T.G. Watkins of Simpler Trading joining us here in the studio. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great night, and we'll see you tomorrow.